think the first time we scheduled this was sometime after Pest World. And the day we had it scheduled for, there was, a really small fire in Malibu, and we lost power in Pacific Palisades. This was back in, I think, November timeframe. And so I had to cancel, which pained me because I don't cancel meetings, especially podcasts, which I know you've been so good on your schedule, like so regularly getting episodes out, which, I know from the boardroom buzz and experience, that's not an easy thing.
No.
But that's kind of a credit to your discipline. Everybody knows what you're about. And, but anyway, so we lost power that time, but then as a lot of folks, obviously know, Pacific Palisades then we had our own fire at the beginning of this year. And so that was a whole nother level. So, which has been a tough situation, quite frankly.
Yeah, for sure. And we won't stay on that topic long, but just how's it been? Like walk me through a little bit of the journey. I know it's gotta be tough for you, the wife, kids, family, like you picked up and moved and.
Yeah, it has. It's been really hard. I mean, I'm a little old school, and I think the word trauma gets a bit overused in today's society, but it was a pretty traumatic experience, I would say, for that whole community and our family. Our kids' school burned down, like the whole thing. And so we're down here in northern San Diego, sort of reestablishing ourselves in this community. Kids are in school, making friends and all that. And my wife and we're adjusting. And so we'll get there, get back on track. So, everybody in this community has been really welcoming to us, which has been awesome to see. A lot of cool, down to earth people down here. And so, the only option is to move forward and adjust and adapt. And at the end of the day, despite it being a really tough experience, I think for everybody, including our kids, I think ultimately it will make them stronger and more adaptable down the road.
Sure.
At least that's my hope, right?
Yeah. Well, you obviously don't know this, but I've been through 2 house fires myself.
Man, is that right?
One I was young, but I was like 3 years old, but I still remember vividly, one portion of it. That was my sister hanging on to me. And I remember looking back at the house and it'd just be a ball of flames. So I remember that. And then my freshman year, the day before my freshman year of high school, I was just sitting in one of the rooms and I was with my little brother. I was like, hey, what's that smell? And he's like, I'm not sure. I'm like, shut the window, because the window was open, and shut the window. And then I was like, man, that's just odd. It's a weird smell. I couldn't really explain it. And I opened up the door from to our room into the living room. And when I opened the door, I see smoke everywhere. And I was like, Mom, Wayne, wake up, And as soon as I said that, the fire alarm started going off and they all ran out the back door. And when you, you probably know, but you plan all this stuff ahead of time. You're thinking if this ever happens, I'm going to go grab this, I'm going to do this. And none of that really actually happens. No. I walked over the fire, not knowing, over the living room into the kitchen. And I jumped up on top of our entertainment center and grabbed a big trophy that I got for wrestling and a pair of sandals. And I walked out the front door. Don't ask me why.
You got your trophy.
Yeah. From there on, I was just kind of like a whirlwind. They didn't want, parents didn't want to leave. Back then there wasn't cell phones really. So I had to run to the neighbor's house, and they had the old school dialer. The good thing is only 3 digits. It took forever. And then called 911. That was 5 minutes later. It seemed like they were there, and there was nothing we could do. Just my little brother and I just jumped on the trampoline and watched our house burn down.
Oh my goodness.
So, but the fire department did a really good job, and there's nothing really you can really do. So I've been through, so I know what it's like. I didn't own the house, so it's different. I didn't have my kids there. I can't imagine what you're going through, what my family went through with us. But so I've been there. I was young, but it's still, I haven't forgot either of them. So yeah, but let's move on to something more fun than that. Jeez.
Let's go. Let's go.
I was out in California, and which I'd love to get connected, but California weather is pretty awesome.
It is. I mean, it has that going for it, right?
The traffic, on the other hand, Jesus Christ, that's what's for the birds.
Yeah. California has a lot of things going for it naturally, but then a lot of things that have a lot of room for improvement, in my opinion.
So we did a lot of cool things. So we went to the zoo. We checked out Disney, obviously the girls.
What zoo? What zoo did you go to?
San Diego Zoo.
Oh, so you were down here, man.
Yeah, the place is pretty cool.
Yeah.
we didn't have much time. Like it was a last minute trip. We had planned it last year. My sister has been in and out of the hospital. And she was having issues with her eye for the past 2 months. And all of a sudden she had to put like drops in her eye like every half hour. She had to go to the doctors every single day, 7:00 in the morning, see the eye doctor for every day for a couple of months. She had cancer before and they were doing radiation through her eye. So her eye is good. But then the doctor cleared her like the day or the Thursday before her day. We got her tickets on Thursday. We left on Sunday. So the doctor cleared her. She called me. She's like, hey, let's go. And so we just made a quick 4-day trip with my girls and my sister. And yeah, we hung out at the zoo, Disney, went to Hollywood. But that traffic, man, 7 lanes wide, 3 miles an hour. I'm like, it was like I'm like, oh, looking at the GPS, it's like, oh, it's only a 2-hour trip from San Diego to Hollywood Boulevard. I'm like, oh, it's gonna be easy. It's 2:30. I looked at it, it was 6 hours. I'm like, you got to be kidding me. But we did it.
You did that trip.
We did it.
Oh my God.
And we probably stayed there for like an hour and we're bounced. But we had to go see it, see the Hollywood sign, check out Hollywood Boulevard, walk that for a little bit. One done strip.
The cool thing to do in Hollywood, in my opinion, is to actually, you can hike up to the Hollywood sign.
That'd be cool.
Which is really cool. Yeah. It gives you sort of a different perspective. It's like, Hollywood Boulevard, it's just, you feel like you're just in a sort of concrete jungle, but then actually hiking up to the Hollywood sign, you can, get a sense of like all the mountains and the scope of the city and everything. So that's kind of cool up there. But yeah, I mean, LA, California, it's all about managing where you're going and at what time and how far you are away from everything. Because if not, you'll be in 6-hour traffic. Like that.
We stayed right in Newport Beach. That was a beautiful town. I mean, it was so clean, unreal. That's probably the cleanest city that I've ever been in. They had like this little grocery store, and every single morning they had the parking lot pressure washed.
Did they really?
It was unreal.
Wow.
It was really cool to see. But anyway, let's get this podcast rolling. Nick Bartolo, appreciate you being here with Essential Partners. A lot of people in the pest control industry obviously know you are lawn care. Maybe it's new to the lawn care people. So for the people that don't know you, Nick, a lot of us do. I want to just do like a quick intro of what you guys do and how you got in this industry of all industries.
I know, right? I was lucky. I'll give you a little bit of background. So, and I'll try not to go back to birth, but Essential Partners is a full service wealth management, investment advisory tax strategy firm. Okay. And as you mentioned, we specialize in home service business owners. Okay. So I got into this in sort of an unconventional way, I would say, for being in wealth management, in that most folks, they come into wealth management out of undergrad. Let's say they get a phone book, they start smiling and dialing and just trying to raise money and get clients, right? And I take nothing away from that because, as you know, as an entrepreneur business owner, sales is business, right? So being able to sell, raise money, that's critically important to any business. But I don't know if I was intimidated by that route. It just didn't sound like, a great path or something that was interesting to me. So I went very technical. So I started off as a CPA actually for a few years right out of undergrad. And then I just became fascinated and, really enthralled with investing. And this was during what I call the OG tech bubble, which was back in, 1998 to 2000, during the, inception of the internet. And I got really interested in investing. And after losing some money, that I couldn't really afford to lose at that time.
Is that like day trading or what?
I didn't know what I was doing, right? Put it that way.
Right.
I was like 22 years old. I was very new to investing. I didn't grow up on Wall Street. I grew up in Vegas, right? And so once that transpired and the market crashed, I figured out that you could actually invest for a living. And I was like, wow, that after, wanting to just be a pro baseball player, I was like, wow, this might be something that I could do for a living. Okay. And so essentially after that, I went to work, right? I started studying, I started reading investing books. And then eventually that led me to work at a big money management firm in one of these rotational programs, these management development programs, before I headed back to USC and got my MBA. Okay. And so I really tried to just focus on the technical aspects, what investing was all about. I ended up convincing a big Wall Street firm, trust company of the West in Los Angeles, to give me a job after business school. And from there, for the next 17 years, I essentially studied public companies to figure out which ones to invest in by really doing deep research and due diligence on those companies, building financial models in a really detailed fashion from the ground up, traveling around the world, meeting with CEOs and CFOs of Fortune 500 companies, and helping to manage money for large institutions. So these could be big endowments, pensions, mutual funds, those types of constituents. And really what I was doing is picking stocks and also bonds to figure out which companies we should invest in. And so did that for 17 years, kind of giving you the long version here, Jonas.
I like the long version. I'm already fascinated writing down questions to ask already.
I mean, I did that, for 17 years and then decided, like you did at a far younger age, that I wanted to have my own business and ultimately create value for clients directly by working directly. And so it kind of reminds me of the Steve Jobs quote that I really like, which is, all business is, any business is adding value to someone else's life. Okay. So, you do that through your businesses. I do that through wealth management, right? But ultimately, if you can add a lot of value to other people's lives, you end up with a good business, and then you end up creating a lot of value for your family, which was also kind of part of this goal in having my own business. So that's how I ended up in wealth management. So I started my own firm after that long career on Wall Street, and kind of been running at that ever since. And I could give you the backstory on pest control and home services as well, but.
Are you sick of paying marketing agencies and not getting results? Well, we are hosting the #1 step-by-step class on how to attract and generate sales without paying a marketing agency or having a huge budget. Most lawn care and pest control owners get stuck at a ceiling because they're dealing with outdated systems or relying on guesswork waiting for the phones to ring. Our upcoming class this Thursday provides proven strategies to generate hundreds of leads without a huge budget. We'll show you how to build a predictable system to grow past $1 million. We show you how to automate your marketing. We'll also teach you how to delegate and build your team so you have more time. So click the link in the description below. Trust me, you're not going to want to miss this. This is the one thing that I wish I had learned a lot sooner. Now, let's get back to the show. You mentioned something that I thought was interesting. You said you want to be a pro baseball player.
I did. That's really, growing up, all I cared about really was like sports and, school. Those were the things that I was into as a kid, right? Sports, school, and my family. And so I played everything growing up. I wrestled too, not for a long period of time. I think you and I have chatted about this. My dad was actually a wrestling coach and is in the State Wrestling Hall of Fame in Nevada for being a high school wrestling coach. Yeah. So I was sort of a limp fish, for a few years when I was really young, right? I wasn't a great wrestler. So I had a short wrestling career, but then, I sort of played everything growing up in high school. Played 3 sports and then sort of, narrowed that down and decided to focus on baseball. But ultimately, I just was not good enough, just was not endowed with enough natural skills to really take it much beyond that. Ended up getting cut in college and focused on the books.
For sure. Were you super competitive in high school, grade school? Were you growing up? Were you super competitive?
Very competitive. Yeah. I had I have an older brother who's 4 years older than me. So we would go at it a lot. He was, a lot older than me and a lot bigger than me. So I would lose those battles. But I think part of that instilled a lot of competitiveness in me. And, just in general, like competitive sports was a huge part of my life, all throughout. Right. So letting go of that, I don't know if you went through this when you stopped playing competitive sports, but letting go of that is
you get lost. Yeah.
It's a big part of your identity.
Yeah. That's why I like business is it's like a sport. It's my new
absolutely.
sport.
Yeah, absolutely.
It's like a video game. Like you're constantly unlocking new levels,
Yeah. And, I was competitive at school as well. Like I took, my parents didn't mess around when it came to school and all that. And so ultimately I didn't either. So that was another arena where I was really competitive in, especially in high school and then, college and grad school. But ultimately I look back at all of these degrees and certifications and all these things that I received. And when I reflect on that, it sort of leads me to one of my first clients in my wealth management firm who owned, who still owns and still is a client, owns a top 30 PCT pest control company. Okay. So I had taken this route where I got all these degrees, my CPA, my CFA, my MBA, all these things, right? And then what that ends up doing is it ends up in this path where you just work for other people your whole life, right? And so an eye opener for me was this first client, pest control company. His business was worth, 120 million plus at that time. Okay. And I'm like, man, I'm like going around the world, meeting with these CEOs, like, thinking that that's kind of neat. It's intellectually stimulating, like, but I'm not special. And I'm just working for people. Okay. Meanwhile, all these other folks that are entrepreneurs from a very young age are helping people, creating tons of value for you and your family. Right. And I don't think a lot of times school and all these advanced degrees really prepare people for that type of endeavor, which ultimately, if you have the right mindset and personality, I think is, far more interesting and valuable. So I came to entrepreneurship late, but it's the best thing I ever did. I love it.
Yeah. So were either of your parents entrepreneurs, and like, where did the entrepreneurship come from?
It's kind of funny, right? So my parents met as high school teachers in Vegas. Okay. And then my dad, after being a high school teacher and not being able to make any money doing that, right? He dealt cards at Caesar's Palace for, I think it was like around 15 years. Okay. Ultimately, he took over my grandfather's failing slot route business. Okay. So it's a route-based business, but it's a bit different in that you basically own video and poker machines and you put them in restaurants or bars and you collect a percentage. Okay. So he turned that business around. So he also came to entrepreneurship late and ended up running that business, and selling it at some point so he could retire. But what's funny is he was really focused on school and having us not necessarily be entrepreneurs, because I think he sort of viewed that as a tough, low probability route of just having, a consistent income stream. So he was more conservative in that way.
So your first your first client that you get for your own company happens to be a pest control client with your friend.
Pest control.
Like how does that? Where was the relationship there?
Yeah. So the way that happened is that I had some longtime friends, 20 plus year friends from my time as a CPA, and these guys have a CPA firm. And so one of their big clients at their CPA firm owned a big pest control business. And so they made that introduction and just sort of went from there. But I didn't necessarily have the clarity at that point to say, I'm just going to focus on pest control or lawn care business owners. It took me a while. So I tried to grow my business for a while, get referrals from CPAs, friends and family. But for me, ultimately, it was just happening too slow. And so I really tried to refine my strategy and think about like, okay, who of my client base do I really like to work with, right? Where do people need a lot of help? And also I wanted to focus on an area that was being acquired by private equity, just like given what I knew about private equity activity overall, and then thinking about my client base and having, a number of pest control clients at that point, because I also had one in Las Vegas, someone I grew up with. And then it really just went from there. I said, you know what, like I like these guys and gals. It hits all of the aspects of something I'm looking for in terms of people I can add a lot of value to, which I think I could help. And then it just happens to be also a good business development opportunity because shoot, these guys are printing money on these transactions.
For sure. it's kind of funny. It's kind of like every other entrepreneur business, like just in different fields. So like at first you gather up any work that you can get, like you'll just take it from all over the place until you're like, okay, I really like this customer avatar. This works really well. It's a good business model. I'm going to go after that. And you're like, okay, this home service industry is where it's at. And then how do you start reaching out to clients from there? Or do they make connections for you?
Yeah. So yeah, you know what? So what I did from there is I met the OG, as you call him.
Yeah. Gee.
Yeah.
How did you meet him? Yeah. Was that through the connection to their pest control company?
It's just, I did whatever I could to, meet Paul and get Paul on the phone and get Paul in person. And I was really fortunate. I mean, Paul, like I have nothing but gratitude towards him, like everything that he's done for me to introduce
the industry
people.
As a whole. Yeah.
The industry as a whole. Like you think of how many pest control owners he's made wealthy through his, M&A activity. And so luckily I did have that different background because Paul, he gets hit up all day, every day by wealth management people. And I don't want to speak for Paul, but I think he respected the fact that I had this long career on Wall Street and was actually an investor and not just somebody who, what I like to call spewed chauffeur knowledge, which is essentially the concept being, and I think this is in large part a big piece of the wealth management industry, is that, if the people on the back of a limousine were talking about a particular topic, the chauffeur could sort of parrot back that information like it was his own, but not necessarily understand the underlying concepts. Okay. And so I do think Paul respected the fact that I'd been in the trenches and actually was an investor for almost 20 years. So luckily he, we developed a relationship over time and started.
So you just picked up the phone and like, I'm going to call this Paul guy.
Yeah, basically, awesome. Email him, whatever I could do, calling his assistant, right?
I'm surprised he didn't tell you to get fucked. Hang up.
Yeah, I know. Me too. Yeah, he probably did a few times, and I just kept going. No, so I was super lucky to meet Paul.
Yeah, it's funny enough. I saw a video that you posted. It was very fascinating because I see it all the time too. I saw it on Facebook today or yesterday or something we were talking about private equity and people getting, evaluation in their business. And I see it all the time, which I'm sure you do in Facebook groups, forums, like, oh, what should I sell how much is my business worth or what can I sell it for? And all of a sudden they're like, yeah, they have a small business doing one route, 250,000, and they think it's worth 5-6 million or whatever, 1-2,
3 times revenue.
Yeah. It's easy all the time.
One route. Yeah.
Yeah. One route. We don't have to talk about that yet, but we can. But I just seen your video, like, it's something that we need to talk about on the podcast because I get that question all the time too. What do you think it's worth? I'm going to go buy this company. They got 200 customers. What do you think it's worth? Like all day long. I'm sure you do too, but
yeah, I think I do. Like, yeah, I mean, I think there's a lot of misconceptions out there and it's probably my fault. It's probably other people's fault that does content in that or does podcasts and all this and that they hear us talk about multiples and they hear us talk about 12 times EBITDA, 20 times EBITDA, especially going back during COVID, 2020, 2021. You had crazy numbers. You had new private equity capital entering the space, buying, let's call them platform businesses, meaning a business that can be the core of a new private equity backed pest control company that can then go out and make smaller acquisitions. But guess what? Like those smaller acquisitions are not going to command the multiple that a platform acquisition will.
So when you say platform, what kind of multiple are you talking? Not multiple, like what kind of revenue are you looking for as a platform? 10 million plus?
It depends. Like typically I would say yes, something like 10 million plus. Okay. But there has been a few platform acquisitions, one in Arizona I can think of where their strategy is to start small and even roll up a smaller business. That way you have a broader range of potential acquirers at that point. But anyway, typically, yeah, let's think about like 10 million plus, right? So what happens then, back to your initial question, is that Then a smaller operator, and I talked to one, a couple of weeks ago, he was doing he saw me speak at the Arizona annual conference, gave me a call, was happy to chat with him, and he was doing 250,000 in revenue. Okay. And he's like, well, do you think I could get maybe like 2 or 3 times, similar to what you're saying about the Facebook groups? And I was like, you know what? Like, no, you're 1 times, right? Like, without knowing anything. And it leads me to another point, which is forget about revenue multiples, right? Everybody uses it as shorthand. Yeah. Especially, yes, everybody uses revenue multiples as shorthand, and they think they should be thinking about revenue multiples. But at the end of the day, as you point out, it's all about EBITDA. EBITDA really being a proxy for what that business can generate in cash flow.
That's all that private equity company wants. They're not buying the business, they're buying cash flow.
That's it. Yeah. For especially a business like your business, right? The size of business that you have, which ultimately is going to be a platform, right? Or other people, but even smaller businesses, right? Like, you can't compare revenue multiples for one business that is generating 10% EBITDA margins for another business that's doing 20%. Okay. So let's just put a finer point on it to up level the conversation a bit. So let's say you have a business that is doing, $100 in revenue, and they say, man, I'm worth 3 times revenue. Of course I am. Okay. And you're like, all right, 3 times revenue. That's what you heard on a podcast is the going rate. What are your margins? Oh, I'm doing 10% EBITDA margins. Okay. So you're doing $10 in EBITDA and you're telling me you're worth 300. Guess what? That's a 30 times EBITDA multiple, and there's no chance. Okay. And so I think that hopefully illustrates why folks out there don't think about revenue multiples. Okay. If you want to use it as a shorthand, it's a bad methodology. Okay. So, and also I've often joked that I want to start a PCT 100 for cash flow and profitability, right? It's like, okay, great. You have everybody focused on revenue. They put up everybody's revenue. They put the revenue growth. But, man, I know guys that are doing 20 plus million in revenue and they're not making any money, right? And it's easy to go to conferences. It's easy to, be in peer groups and brag about your revenue and your revenue growth. But ultimately, if you're not making any cash flow, then you don't have a business that is that valuable that private equity or any strategic acquirer really wants to pay a high multiple for.
Yeah, I agree. And just getting to shooting for that 20% margin, getting to that, $1 million in profit. It's just a goal that everyone should be shooting for. It's all about the bottom line. And I think a lot, even me as an operator, early on, I didn't understand it either. Like you said, you're in the peer groups and they're pushing, it's that 500,000, million, 2 million, 3 million, they're all pushing through that, comparing apples to apples. And at the end of the day, none of it matters. Cause you have a $20 million business doing 800,000 in profit. You're still going to be worth the multiple of your EBITDA.
Yeah, no, exactly. And I mean, early on, look, you need to get scaled up a bit, right? So, and if you have investment opportunities within your business, you should be plowing that money back into your business, right? But you can also measure that and factor that into what your sort of run rate sustainable EBITDA is without that incremental investment. Okay. And it just kind of reminds me of this, to bring it back to wealth management for a second, but it reminds me of this wealth management concept where it's okay, you're a small business owner or medium-sized business owner, and you're growing this concentrated asset, and you have some wealth management guy with his own self-interest telling you, hey, Jonas, you know what you should do? You should actually give me some of that money and diversify, right? Because diversification is so important. I can take it and I can invest it in this and that, but that's the absolutely wrong approach for nearly all business owners, particularly when they're on that growth curve and have good investment opportunities. Because the way that you get rich is that you grow a concentrated asset to a big pool of capital as you potentially exit. Okay. The way you stay rich, I do believe, is diversification, right? And having a more broad basket of investments. But that would be the absolute wrong advice for somebody that's just growing and building this, very valuable concentrated business asset.
Yeah. What's I know you're highly involved in M&A in the marketplace right now. What have you seen for activity? I know there's been some big deals that went through, but overall, what's your perspective on it?
I'm not a consultant and I'm not an M&A advisor, right? I always say those two things right off the bat. Like I'll leave the consulting and coaching to my good friend, Seth Garber, and I'll leave the M&A to Paul and Franco and Potomac. Okay. But that being said, clearly I do work with guys and gals who are thinking about selling their business or who have recently sold their business. Okay. And, what I'm sort of seeing out there is there's still a lot of activity. Okay. There's still dozens and dozens of private equity firms that are acquiring businesses and want to be in pest control. There's also, I would say, maybe even a renewed activity from some of the strategic acquirers. We recently saw, the big Rollins deal when they acquired Sala, right? Which was a great outcome for those folks. And however, back to this multiple conversation, I want to make sure, and I, posted something on this today. I want to make sure that owners out there have realistic expectations about multiples. Okay. So thinking about 17, 18, 20 times EBITDA, I just think is not a realistic scenario. One thing, and so to your question, I do think there's tons of activity, but I think multiples are past their peak based on what I'm seeing and hearing. Okay. One thing that we do for owners at Essential Partners is we do an analysis. I call it thinking about the possible paths. Okay. Because there's a few types of folks that we work with. Some are 2 to 3 years away from an exit. And I like to check in with those folks at least once a year, maybe twice a year. People that are growing sizable businesses that are likely to exit at some point. Okay. But then there's the people that are maybe, within the next 6 to 12 months, maybe even 18 months away from an exit. And that's when it starts becoming more difficult in thinking about this concept of when they should actually sell. Okay. So what we do in this, I just call it possible paths analysis, is that we model out their business. Clearly that's a collaborative effort coming from them, like what they think their revenue can do over the coming years. And what, more importantly, back to this EBITDA conversation, what they think EBITDA is likely to be. And so then from there, you can really decipher what the likely cash flow is that they're going to be able to pull out of the business. And then think about the business valuation at different points in the future, given a changing or different scenarios around multiples. So if we're sitting here and someone has a $50 million offer on the table, and that's at 15 times EBITDA, let's say, given that's a sizable platform acquisition, let's say they don't take it. They continue to grow the business and EBITDA, but what if multiples go to 12 times? And 3 years down the road, they can only get 12 times. Like, as a business owner, I would want to know what that scenario looks like, okay? Because that's a real scenario that could transpire. And so thinking about those possible paths, I think, is really important, because it also, from a psychological perspective, it really preconditions you to different outcomes, which allows you to adapt over time and think about what is my confidence that I can continue to grow EBITDA at 15%? And, Nick's telling me that multiples are past the peak. What if multiples do go a lot lower than I think they can? So maybe I might get 50 million 3 years from now, even though I continue to grow my business. So just preparing oneself for that outcome, I think, is helpful. And then we also link it to their investments, because ultimately, once someone exits, they're going to have to be able to make money off their money, pay as little as tax as possible, but then draw cash flow from their investments, as opposed to drawing cash flow from their business in order to fund their lifestyle. So those pieces of analysis all weave together, which hopefully allows for, I would say, better decision making, but more well-informed decision making. Because people just like, they don't do that work, Jonas, and then they just come up with these ideas. I think is a matter of like shorthand where they're, what do you want to sell your business for? 100 million. Right? It's like, well, if I sell it for 100 million, I probably can't screw that up. So I might as well wait until I'm at 100 million, as opposed to potentially taking a more analytical approach.
For sure. I like that a lot. The reason I asked is I had a call this week with a guy, $6.5 million for a weed control company. But he kind of thought that's how he's thinking about it too. He's like, they're offering me, I think it's 12 or 13 times EBITDA. And he's like, should I hold? I'm like, I'm not answering that for you. But I took him through a couple of scenarios, what I thought. I'm curious to what you would say back to that.
So what I would say is I would take him first through that possible paths analysis. And then I also think
he's running a 29% margin too.
It's a great margin. That's a great margin.
I think it's either 12 or 13 times EBITDA. He's 46 years old.
Yeah. That's another key, factor and something to consider. But it's like, okay, the personal factors and what his life and his family looks like from a personal perspective matters a lot. How old are they? How much money do they spend? Do they know how much tax they're going to pay on the sale, on the transaction? And then do they have a reliable strategy where they can actually generate investment returns without suffering crazy volatility, something that's resilient, where they can also pull cash flow out of their investment? So to me, that's where the preparation comes in. But oftentimes it's like, look, like I can't run a weed control business. I can't run a pest control business. Just like this person that you're talking about probably doesn't have a great sense of what their investment strategy should be if they were able to cash that check for that type of money, to then have this more wealth-based mindset of generating profit off their money. Okay. So that is why I always encourage folks to chat with me early on, because it might not be a client relationship for a number of years, but it just starts to provide that education and preparation for these big decisions. I mean, I really don't know. Like, how is that person supposed to make a decision if they don't know what they're going to do with the money? Right. But it's rare, to be honest. Right. Most people don't. They just say, oh man, I always wanted to sell my business for 20 million. I got it. I'm done. And then the default ends up being like, I'm going to go buy some real estate. Right. Which I'm not here to poo-poo real estate or say that's a bad investment. I think it should be part of the mix. Absolutely. But the reason they do it, Jonas, is because it's like, again, it's like, it's all they know.
Yeah. And I think, my answer was not as good as yours, but like the way I looked at it too is he's like, well, I can run a $6.5 million company, but I don't know if I can run a $15 million company. Like, well, you can, you just have to get better. Like we're no different, right? It's just like, you just got to get better at the skills that you're lacking in. We all have the same opportunity. And then it's like, where else can you get 29% return on your money? That's tough.
Yeah. No, absolutely. But that's a great point that you made to him, in that you do have to think critically about that, because what got you to 6.5 million is not going to get you to 13, 14, 15 million. Right. And so some people, they're just like, you know what? I don't want to do that. And that's fine. Right. Like, you want to do it. Like, I know how you are. You want to do it. Right. I would want to do it. But some people are like, you know what? I have this really strong niche with great route density. And if I want to double my business again, I'm going to have to expand out of that. I'm going to have to then dense up. There's going to be an investment period. I'm going to have like 3-4 new managers. And you know what? Like, I'm 49, I'm 60, whatever. I don't want to do it. And it's like, no judgment, but that possible paths analysis, it also uncovers those types of things where people say, oh, you know what? I'm growing 30%. I'm going to grow at least 20% for the next 5 years. And then you look at that number, Like, oh, so you're going to be 50 million in revenue? And it's like, there's not many companies. There's not many pest control companies that are 50 million in revenue. What is it actually going to take to get there?
But even still, we talked about platform companies early on, right? It's like, okay, you're at 6.5 million now, but what would it take to get you to 10? Because at 10, you got a better multiple than you were at 6.5. Could you grow? And like you said, things could change, like in multiples could go down, but that's just kind of how I look at it too. Like, okay, I'm 4.5 million away from a platform company where I get a better multiple. Even 13 is really good. So give them that. How long would it take me to get to there? And yeah, the multiples on EBITDA could change, but will they change that dramatic? But it's a conversation to have. And yeah, it's definitely something you got to think through for sure.
Yeah. Yeah. I do think it's important that people really just understand the range of probabilities of what a multiple could be, because we've, for the last, let's call it 15, 16 years, lived in this world of financial repression where interest rates were artificially low. Okay. Ever since the great financial crisis in 2009. And when you're in that type of environment, that props up multiples, particularly when there's this wave of capital coming from private equity. Okay. Interest rates have now normalized. I don't necessarily consider them high relative to history, but they have normalized, which suppresses multiples a bit. And then if private equity were to step back to any degree, it's going to hurt multiples, right? And if private equity, one thing that's really topical right now is that private equity, not in pest control or lawn care or weed, but overall, private equity is having a very challenging time exiting their businesses. Okay. So in some ways, this is trapping a lot of capital in existing investments. And without being able to sell those investments, then it's challenging for them to raise money from their investors because they still haven't given back the money from the prior vintages of the private equity funds. Okay. So then let's say public market multiples come down. Now the exit multiple for private equity, theoretically is also lower. So can they then acquire businesses at the high multiples that they have in the past? Again, it's like, I would say it's not me being a pessimist or certainly not wanting people to sell for high multiples. I want people to kill it, right? But it's more so like, let's be sober about like the idea that like, let's prepare ourselves, because if you are doing this and you have these rosy expectations, that's just going to lead to potential disappointment, which no one wants.
Yeah. Have you seen the bad side of private equity? Or have you been lucky enough to be all good deals?
I think there's a bad side to all types of acquirers. There can be a bad side to strategic acquirers, like any of the public companies, right? I think Rollins has an excellent reputation, well-deserved, right? But, there are other instances where owners don't feel great about what transpires after they sell their business, okay? And so I do think there's plenty of private equity firms out there, though, that have brought a lot of operating discipline to pest control companies. I know guys that have sold to private equity who were growing 15% with nearly, let's say 27, 28% EBITDA margins. Okay. Next thing you know, they sell to a well-run private equity backed pest control firm. And now margins are in the low 30s. It's just sort of, eye-popping, to be honest, like what they've been able to do with some businesses. So there's a lot of great stories about private equity as well.
For sure. Yeah, I agree. What is your investment philosophy? How do you help people make money? I know we kind of touched on it a little bit, but what's your strategy?
Yeah. Look, there's a lot of jargon in my business, right? And I think a lot of it is hard for folks to understand that haven't been exposed to it. And why would they, right? They're too busy making money in pest control and building a ton of value, or lawn care. And so I like to think of this idea of like what we'll actually do with your money in plain English, right? Because that to me is like what I would want if the roles were reversed. So ultimately, one way we make people money is by just owning a piece of the best businesses in the world. Okay. So this could just be executed through low cost index funds to own fractional shares of public companies. So across the board, right? Not just in the US, but globally. That's one piece. Another way that we make people money, and something that ends up being a very good income replacement for owners, is something called private loan funds. So what a private loan fund is just back to this concept of what we'll do with your money in plain English. A private loan fund is just loaning money to a private equity firm to buy a business. Okay. So I'll give you an example. So say someone acquires your business, Jonas, for $100 million. Okay. A private equity backed company. They don't take $100 million from their investors and just buy your business. They'll take $60 million from their private equity fund. Okay. So the big endowments, pensions, et cetera, that they have as investors. And then they need $40 million more. Okay. So they'll go over here and they'll borrow $40 million from a private loan fund. And so the private loan fund, these folks, they're managed by multi-$100 billion asset management firms. They go and they underwrite your business to make sure that they are going to get paid back. And so the $40 million will come from one of these loan funds. So now they have the $100 million to acquire your business. And the compensation for making that loan currently for my clients is about 10% paid in monthly distributions. So that's a good return that's commensurate with what stocks have done over time, and it's far less risky. Okay, because the private equity firm, they think your business is going to be worth 3, 4, 500 million in 5 years, and we're loaning 40 million to that. Okay, so that's another way that we help folks make money. Another more even simpler idea is that loaning money to the U.S. government. That could be what's commonly referred to in jargon as T-bills, T-bonds, treasury bonds, U.S. government
return,
bonds.
right?
Yeah. So right now, you can get 4.3% and something like that. And say what you want about the government. I have plenty of, criticisms of all the wasteful spending, but as long as we have the strongest military in the world and the ability to print our own currency, the US government is paying that back. Okay. And that's why Warren Buffett has $350 billion in US T-bills, essentially loaning money to the US government. Okay. We also like to have investments in areas that I like to say cannot be printed by the US government. Okay. So there's been a lot of reckless monetary and fiscal policy by the Fed and politicians over the years, which ultimately creates a debasement of the US dollar. And so we want to own things like gold, right? Which was up 30% last year. It's up another 30% this year. Real estate, commodities. So like a broad basket of commodities, oil, wheat, copper, other grains, natural gas. And over time, if you actually study the data, these areas that I like to say can't be printed, those typically do really well when stocks and bonds are doing poorly. Back to this idea of like not subjecting our clients to undue volatility, yet still trying to earn a good return over a long period of time. So those are some of the areas. Like there's a lot of more, nuanced things we do. I mean, the other would really be we utilize technology to try to generate market-beating returns while also implementing effective tax saving strategies. Okay, so there's a number of strategies that have been deployed and developed by billionaires using quantitative investment strategies over the last several years. And these strategies not only generate an investment return, but they can also be highly effective at mitigating taxes on a business sale.
Yeah, because that was going to be my next question. Like, okay, so I got acquired for the 100 million. I'm going to pay boatload in taxes. How do you help us save that? What's the strategy to help us save there?
Yeah. I mean, look, I've probably thought about that problem more than anyone in the world, to be honest, like with these industries. And so depending on the situation, depending on, someone's, I would say like personal factors, like are they charitably inclined? At what point in the year did they sell? Do they have capital in the years leading up to a sale that we can deploy into some of these tax saving strategies in order to actually mitigate taxes on the sale? And then it's like, okay, is it the initial business sale or is it the earnout or the rolled equity? those two, we can actually do a lot more damage to the tax situation, positive damage to the tax situation in order to reduce those taxes. But, even on the initial sale, we found in a lot of instances that, lowering that tax bill by 20% is an outcome that, has certainly been achieved with a number of our client partners over the years. Yeah. So
do you tell I wouldn't say all, but a lot of your clients to roll some of their equity, or is it just different on every single deal?
it's a good question. I think it is really different on every single deal. Okay. So for instance, if you're selling to a company that started a roll-up pest control company backed by private equity 5 years ago, and they're ready to exit in the next year or the next 6 months, or let's say the next 18 months, you're not likely to get a big multiple on the rolled equity that you accept from them. You might get even money, right? You may get 25% higher, right? Versus if you sell to a private equity firm, let's say you sell to somebody who, and these are out there in the market today, where you might have a buyer who has had a lot of success starting and growing a private equity backed pest control company, but now they might have their own fund and they're going to do it again. And you're the first platform that they're going to acquire. Now you're in a position where if that private equity backed company is successful, you're the first platform. Okay. You're going to have 5 to 10 years of opportunity to create value. And you create value by acquiring new pest control companies, by growing your own pest control company that was the first platform, taking advantage of synergies, taking advantage of just sound corporate governance and operating principles to increase the profitability. And you have a long runway to do it. Okay. So in a situation like that, then it's like, well, everybody's situation is different, but that's the type of situation that I describe where you want to be a bit more aggressive, most likely, on taking more rolled equity.
But also it's a little bit more risk, right? Because that
it is. Yeah. So it's like, you took some money off the table and you're going to have the quote unquote second bite at the apple, but you are taking more risk.
Yeah, because you could have the second, third, fourth, fifth, sixth, seventh bite of that apple over the next 7 years.
You could. Yeah. Yeah. So it just depends, and some folks, they're like, you know what? Yeah, I take some money off the table and I'm still rolling with the new company, but maybe I'd rather just control it myself. Maybe I should just keep growing, because ultimately, if you're banking on a high exit value for the company that acquired you, and then that doesn't happen, there can be an incongruence here where it's like, okay, if I sell now at a high multiple and then I just roll on my own and continue to grow, and then let's say multiples decline, you have to make sure that you're analyzing kind of apples to apples, where if I roll on my own, I grow, but multiples decline, and then I try to compare that with the scenario where I sell a bit now and then I think I'm going to get 5x my money, like those two scenarios on a 4 or 5 year basis aren't congruent. So you need to make sure that that's sort of that lower multiple expectation is also reflected in what you think you're going to earn on the private equity rolled equity component. So, but yeah, it's tough. Like you're making decisions with imperfect information, and everybody's different and how they think about money, how they think about risk, how much money they need to live and all that. Right.
For sure. But at what point do operators take some chips off the table? Because you see the companies will do like 10, 30, 50, $60 million. And all of a sudden they're like, okay, now it's time to take some chips off the table. Because there is a lot of risk out there. There's a couple hundred trucks now, There
is. I know there is. I mean, pest control owners are lucky in that the business is recession resistant. There are certainly risks. There's certainly, it's recurring, obviously, and there's certainly risks, but if you have really good insurance, right? Like, yeah, no one wants to get that call in the middle of the night that someone took one of the trucks and they had a bunch of drinks and, ran off the road, something of that nature. But, I would say that the risks aren't quite as great as, they might seem if you're well insured and all that. But so when do people take money off the table, to your question? I would say that it's just every situation is so unique, right? I mean, I think age plays a big role in the decision, and then just like the size of the numbers and what someone's mindset is, right? Like, shoot, guys like you, Jonas, I mean, every time you grow to a next level of revenue, you're probably just going to continue to challenge yourself and be like, well, if I was able to do this, like, why couldn't I do that? Like, nothing's going to limit me. Not everybody has that mindset though, right? Especially as they get older, and like next thing you know, they're in their 50s or late 40s, and they're like, you know what? Like, I've been running hard for 20 years. My business is worth 50 million. I think it's time. Like, I'm good, right? I miss a lot of events with my kids potentially if their business isn't set up properly, or not properly, but like if they're in the business and they like working on the business, but it's taken a lot of time for them. So it's just different.
I agree. And again, I feel like I talk to a lot of people, and I can run across a lot of those scenarios, and just wonder what you think about it all.
I mean, I think it is good to still take money off the table, right? Because again, like back to this concept of multiples, and things have been really great on a lot of levels, right? The business has been great. The economy has been great. Interest rates have been low. Valuation multiples have been high. I guess I'm old enough to remember that OG tech bubble crash. I'm old enough and lived and invested through the great financial crisis. And, look, like Microsoft, one of the best companies in the world, traded at less than 8 times EBITDA for, I believe it was 3 or 4 years. Okay. That's Microsoft. So to think a pest control company can't trade at or be acquired for 10 times EBITDA, I just think it's a bit too optimistic. Even though I hope they all sell for 20.
Of course. Absolutely. Like, we want to see everyone win. But and here's another thing. So we talked about a little bit too about taxes. Like, I hear a lot of people, again, going granular way back, but you hear people like say, I don't want to pay in taxes this year, so I'm just going to go purchase a truck or buy some equipment. What's your philosophy around taxes?
So I think of taxes really sort of in 3 stages. It's like while you're operating, during a sale, and post-sale. Okay. So while you're operating, I think if you need trucks, or it's borderline that you need trucks and can make that capital investment and get that depreciation write off in the first year, which by the way, though, it's not 100% right now, right? I think last year it was 60%, the year before 80. And so you don't quite get the bang for your buck that you used to. So I certainly don't think someone should be buying trucks that they don't need and that they're not going to grow into just to offset taxes. Okay. You could probably say the same thing about chemicals, which is another thing that ends up happening. So while you're operating though, there obviously are a lot of ways that you can try to mitigate taxes just through your business. Okay. And the first thing I typically tell folks though is like, get a good CPA, right? Like, I'm a CPA, but we don't do taxes. But folks need to really focus on getting a good value-driven CPA, not just a compliance-driven CPA.
I agree. And when I made that switch, like I'm telling you, it was absolutely a massive unlock. So for listeners that are on here, that is some of the best advice that I could give. That's a massive unlock.
Yeah, because you're leaving tens of thousands of dollars on the table in taxes, if not more. Okay. And then on the taxes during the sale, that's what we specialize in, right? Not only the taxes during the sale, but mitigating taxes on investments and the money you make after the sale. Okay. So there's really sort of those 3 dimensions of how we think about tax. And I would say like that is sort of one thing that typically differentiates us from other wealth advisors, is that we have a much more acute focus on tax mitigation. Because look, at the end of the day, like I can sit here and tell you what a great investor I am, and we'll do well for people. Okay. We'll do well for people. But tax is like, it's just quantifiable, right? It's like, if you can save somebody millions of dollars on tax, like all the investment stuff just ends up being free forever. right? And so I'm selfish like that. I want to prove, quantifiable value for decades to come.
For sure. When do you like to start talking with owners? Like early on? I know you said you have two people that you typically work with, but when do you like to start making those connections?
Yeah, I like to start talking to folks like at least 2 to 3 years before they sell. Okay. That way we can go through some of these topics, some of which we've talked about today, and check in with them, once a year. That way they're just sort of thinking about the characteristics and the areas where we can move the needle on planning. Okay. It doesn't have to be 10 years before, it doesn't have to be 5 years before, but a few years before is definitely beneficial. And then if someone's in process, I mean, now it's like game time, right? Like we really need to be on that leading up to any LOI or any closing. Okay. I mean, there's a number of things that can be strategized at that point to really save money. But all that being said, like if someone's already sold and they need an effective investment strategy and also tax mitigation on what they're earning, because that's usually the point in someone's journey where they become very surprised in that they're making all this money off their investments and then they realize like, oh my gosh, I'm paying a 37% marginal tax rate on those income producing investments just to the federal government, maybe another 5% or more to my state. What do I do about that? Okay. And again, there's been a number of strategies that we've been deploying over a number of years to really lower that ordinary income tax for somebody on their investments.
I like that. If you're like a young operator, doesn't matter what industry, service-based, but lawn care, pest control, and you're trying to think long-term, what could an operator do now that could change their financial situation for the rest of their life?
A lot of folks, I think, understand that, a lot of clients that we work with, sort of like fit the profile of having a lot of money, like tens of millions of dollars, right? And so one thing that I like to do when I go and I speak at some of these, state conferences, et cetera, or stuff that I'll do with Seth Garber on Pest Daily, is really try to provide some education for the operator, for the operator that's mid-career or early on, or their salespeople or their technicians, to really try to help them, increase their long-term net worth. Okay. And so along those lines, one thing that I think is the first step that everybody should take is to get a Roth IRA. Okay. And what a Roth IRA is I'm sure a lot of people have heard of it. I'm sure a lot of people have it, but probably more often than not, they don't. And that's because they just haven't taken the time to read about it, fill out the annoying paperwork, open an account at Schwab or Fidelity, et cetera, et cetera. And so what a Roth IRA is, though, is it allows you to make contributions every year on an after-tax basis. So the current limit is $7,000, okay? So you pay tax on your income, you then contribute $7,000 every year. And as that grows, if you ever pull it out, which you can after you're 59, you never pay tax on it again, okay? So that's an incredibly valuable account because you can invest it and it compounds for decade after decade. So grows decade after decade, and then you never pay tax on it. So if you actually run the numbers, so let's say that you and your spouse both contribute $7,000 per year, so $14,000 annually. And let's say you do that for 25 years and it grows at 8% annually over that time. That's $1 million in 25 years. And you never have to pay tax on that again. Okay. So to me, like that's something that's very achievable, not for everybody, right? Like $14,000 is a lot of money for some people, but as a goal, that's something that's very achievable where you're like, you know what, I could be a millionaire in 25 years, even though I'm making whatever I'm making right now. Okay. And
it's like $1,100 a month, right?
Yeah. Wow. Yeah. Exactly. Yeah. So that's something like, for the the mid-career operator, the smaller operator, or even, something for that owner of the business, the lawn care business, the pest control business. Talk to your employees about that, right? So that's an effective strategy, just to, be a millionaire in 25 years. Same thing. I mean, the other thing is just like the basics. If the company has a simple IRA, which is very common for small businesses, less than 100 employees, or if they have a 401k plan, just being able to continuously, paycheck after paycheck, contribute to that tax deferred account, which is different because a simple IRA or a 401k means that you don't pay tax on the dollars that you're contributing to that plan each year. It can grow then tax free without ever paying tax. But at the end, when you pull it out, you do pay tax. Okay. But still, you're paying less tax every year. And then at the end, after the money has grown all those years, then you pay tax. So I think those, just like right off the bat, if you can execute those simple strategies as a mid-career owner or as a tech or salesperson or an admin, whatever the case may be, those are good, solid strategies.
Yeah, just the compound interest. So like, I think my uncle, Dennis, he told me young, like, you just gotta start putting some money away. He helped me set it all up. I think it was like a Roth or 401k. Like back in the day, it was like I was putting like $100 a month maybe, and then it went to 400, then it went to 1,000, and it started off super small. Like it didn't grow very fast. Then all of a sudden, like you fast forward those 5-10 years, like holy man, there's a big pile of money. Like it's pretty cool. See what they've done with it. So it's simple, very simple. Like I said, yeah, it's kind of a pain in the butt. Just go down there. It doesn't take a whole lot of effort. Just walk into their office, get set up, pretty easy.
And there's a mindset and a discipline associated with that I think can just carry over to other parts of people's lives, right? Knowing that like, you know what, like I'm not going out and blowing all my money. I'm saving this amount. And I know if I continue to do that, it's going to pay off at some point, right? And I think that then seeps into other part of their actions.
Yeah. So let's go talk about operators still. Let's just say you're doing 250 to $1 million roughly in revenue. Where would you tell those operators to try to get to be, to be able to retire someday?
Retirement's a funny concept.
That's never going to happen to me. So.
Me neither. No way. I thought when I was young, I was like, I want to retire. I want to get rich and retire. And now I'm like,
maybe the better word is to sell. I think that's probably a better word.
Yeah. So it really starts with how much money they spend. Like, what is their lifestyle and what do they think their lifestyle is going to be? So one thing that we do as a part of this possible paths analysis is that my team will model out their financial picture, just like their personal situation. It really comes down to what do you own? What do you owe? What do you make? And what do you spend? Okay. So just like very simplistically my team's not budgeting for people. We don't want to see people's budgets. They should be doing that on their own. But if you model these financial attributes or these financial variables out into the future, you can then sort of back into how much they need in order to meet all of those financial obligations and that lifestyle based on their situation. So that effectively can then tell you like, okay, in order for you to continue living like you're living, or maybe we can model in an upgrade of lifestyle if that's something that they're interested in.
We all want upgraded lifestyles.
That's right, man. Just stuff. We need stuff. Forget experiences. We need stuff. No. Yeah, right. Because then you can have like a more intelligent analytical conversation about when they should actually sell, right? And then, all the other factors come in like, okay, well, if you're doing $750,000 in revenue versus $1.5 million, you could see a big difference between those two, or 2 million in what EBITDA multiple you could actually get. Okay. And then it's also like, I don't want to go on too much of a valuation tangent. I was going to say then it becomes like the profitability and what is your route density? How could that fit into a potential acquirer's existing business to where they could uplift the profitability of your routes just because their routes are, enveloped within where you operate. So there's a million different factors that go into it, but look, like I think anyone at that $250,000, $500,000 level, like having a goal to get to 1.5, 2, I mean, you're going to see that your net worth like increase exponentially between those levels, right? It's not easy. It's not easy to do. Like you've been there, right?
Yeah, it's like you get to that 800 to 1,000 or 800,000 to 1,000,000, and it's a sweet spot. Really cool. You got 3 or 4 technicians out there doing a little bit of work yourself. You're kind of like the manager of it, but it's going pretty smoothly. Then you get to that $2-3 million hump, and then you're bringing on managers, and you lose profitability. Let's just say you're doing $2 million, 20% EBITDA, so you have 200,000. But in order to get to 5 to 6 to 10 million, you're going to need that really good operator that's going to it's going to cost you 200,000. So like, okay, well, I'm making $250,000 in EBITDA. I got to pay this dude 200. Like, what am I going to do here? So it gets tough there.
Yeah, it's tough. And it's all mindset. It's all mindset too, right? It's like, you get comfortable and you're like, all right, I'm making 150 grand, right? I'm good, right? Because whatever, we were all raised in our own way, but a lot of us like put those limits on ourselves and think like, oh no, if you would have told me when I was 20 years old, I'm not speaking for myself, but just in generally, that like I could make $100,000 running my own business, I'll take that any day. So like, I'm good. And guess what? Like, I don't have any judgment about that. Like plenty of people do that and they are good.
Yeah. And there's absolutely nothing wrong with it. I say it all the time, but just know when you're taking that $80,000 to $100,000 a year, you're sucking the cash out of it now. Just when you go to sell a thing, just know then that's not going to be worth anything. Because I run into operators all the time that are 1 route, 2 routes, making $80,000, $100,000 a year. They want to sell this thing. And like I said, you want to get 3 times multiple off the thing that's doing $250,000 a year. I'm like, I can't help you, man. Like, I don't even want to give you an offer because it'd be like smack in the face. And I don't want to do that. But it happens all the time. So just know if you're listening and you're doing that, there's nothing wrong with it. Just know when you go to exit, that's not going to be worth much. I didn't say 0, but just not worth much,
Yeah, no, absolutely. You're right.
And there's a lot of wealth companies out there, right, that do this for a living. But what makes you different, Nick? Besides you're a stud and you're in the industry, which is
I have a lot of friends in the industry. That's what makes me different. That's what makes me different now. Nah, man, the industry has been so good to me. It's like the best thing that ever happened to me. But look, I think ultimately, Jonas, it's like we've thought about this specific group of people, any route-based home service business, law and pest control. We've thought about this specific group of people and the specific problems that they have financially more than anybody in the world. And so that might be pre-sale, during the sale, after the sale, right? Really thinking about how we can add the most value to those folks in those problems. So we're not out there thinking about like, oh, I have an executive stock option plan and how can I minimize the taxes on that? Like, we don't do that. Like, we work with business owners who are approaching a sale to help them mitigate taxes on the sale and make and keep more money while also minimizing volatility after the sale. Okay. There's a lot of other nuance around that. Like we talked about my investment background, like most folks that have a wealth management firm haven't really, invested on Wall Street for 20 years. Okay. We also, I would say the thing that differentiates us is that we only get paid by our clients. So sadly, and it was like part of my hesitation even in entering this industry, is that the wealth management industry has sort of made a science out of hiding how they get paid. So, oh, hey, Jonas, why don't you give me $5 million? I can put it in this mutual fund and I'll take a 5% commission right off the top. I swear it's like, the best investment that you're going to make. I'm not skewed at all by my incentives, which I think you and I both know is just total garbage, right? So we want to have really clear incentives to work on behalf and make the best decisions for our client partners, okay? That also includes the ownership structure of the firm. So I own 100% of the firm. So I don't have a boss. I don't have shareholders. I don't have anyone I need to cater to except my client partners. Okay. And again, that just like creates alignment. So that's not always the case though. I mean, shoot, there's been a lot of private equity activity in my industry, a lot of companies that have been acquired, and now they need to cater to their private equity owners and really try to extract as much value as they can from their clients, maybe cut costs and make decisions that they wouldn't otherwise make if they were just purely in the best interest of their clients. Okay. But I think like the biggest thing is just, focused on the specific problems that folks in this industry, business owners, are facing.
I love that. Before we wrap this up, I always ask in the podcast with a couple questions. I know you said early on you started reading a lot of books on investing. Any book recommendations?
Yeah, like one of my favorite books is called Poor Charlie's Almanac. Okay. The Wit and Wisdom of Charlie Munger. So, Charlie Munger was Warren Buffett's longtime partner, vice chairman of Berkshire Hathaway. He passed away at the end of like probably 15, 16 months ago, a month before his 100th birthday. Okay. And that book, he never wrote a book. I mean, the guy has read more biographies and autobiographies than anyone probably of all time, certainly that was living when he did it. But he never wrote his own autobiography or had a biography written about him. So Poor Charlie's Almanac is a collection primarily of speeches that he gave at varying organizations. Maybe one or two of them were actually at my alma mater, USC. And then he also has a section in that book that's called The Psychology of Misjudgment, I believe. I can't remember exactly what the chapter is called, but it's all about psychology and various psychological traits and factors to look into, because he thinks that is sort of a dismal science and hasn't been really well researched. And so he gives his take on it. Because Charlie Munger was really a master of mental models and multidisciplinary thinking in studying and taking the most important concepts from different disciplines and bringing those together to help his decision making. And so that's like, I mean, it's a big book. I don't have my copy here, but that's a really big book, but something that I think a lot of people could take a lot from. I mean, recently I did, it's great. I mean, I think a lot of it too is there's some unconventional lessons in there, right? One of them being is that business owners, entrepreneurs, like we all have these big plans, right? Like I'm going to go to 100 million in revenue. I'm going to do this. I'm going to grow at this percent, that percent. And what ends up happening is that can be a trap for poor decision making. So Charlie Munger was fond of saying that like at Berkshire Hathaway, there was never a master plan. We never had any strategic plans. We never had any long-term goals because plans end up taking a life of their own. That was part of his quote. And that it doesn't lead to flexibility and better decision-making as the environment changes. You might even miss opportunities. Okay. And I think that's somewhat of an unconventional lesson because I do think that goal setting is very important and having those strategic plans is important on one hand, but you also have to have the flexibility to allow that to change. So if you're running around and you're telling everybody at conferences, I think we're both probably going to go to Equip, the lawn care conference later this year. And it's like, everybody's saying like, oh, I'm going to do this, I'm going to do that. But like, if you don't leave the mental latitude to be able to change those plans, then you could fail, right? Like you're spending to hit these plans, profitability suffers, route density goes down. Next thing you know, you're not making any money and you're bleeding cash, but still trying to invest in marketing. Okay. All of a sudden you're pulling money out of your personal bank account in order to fund the business. Okay. I've seen it happen to public companies. I've seen it happen to all types of, route-based businesses. And so that's like one lesson that I'll just, pick out and cherry pick from Charlie Munger that, is encapsulated in some of the stories in that book.
I love that. Any last pieces of advice for us idiot operators?
Yeah, right. You guys are killing it. I would say like my only piece of advice, and we talked about it a lot, is to actually run the numbers on whatever you're doing. Try to run the numbers. Okay. You might not know how. Ask somebody that's been there before you, but like actually run the numbers. Okay. That could be on your Like how are you making decisions on marketing spend? Are you truly measuring as best as you can? It's not perfect, right? But are you truly measuring your return on investment on your marketing?
What's your LTV to CAC gross
What
profit?
is it? What is it? Yeah, exactly. Like that's just fundamental to every consumer business, right?
And it takes a long time to, again, it took me a long time to get there. Not everyone, because there wasn't YouTube and all that stuff out there in the books that they're written now. But just knowing those simple numbers, again, Cogwell game changers, that's one of them.
That's it. Yeah, the customer lifetime value, right? Like if you can understand the present value, the customer lifetime value, and you really understand the variables that are contained within that calculation. This is another Munger one. Like Munger was big on, he said, oftentimes business is about either minimizing or maximizing certain variables. Okay. And so maximizing the lifetime value of a customer is core to creating a lot of value in lawn and pest control. Okay. And then it's like, well, how do you do that? Well, if you can maximize retention, then there's less customers that you have to spend in order to replace them. That means then you become more efficient in your capital spending in order to hit your growth targets, right? So like really like take a few of those variables. What should I maximize? What should I minimize? And like take that simple concept very seriously.
Yeah. And I think as a young operator, a lot of them, just me included, early on, we're just super ADD. We're just trying to work on everything, where we should just focus on a few key levers and models that will really move the needle. Once I figured out those kind of things is when the business changed for me.
Interesting. That's cool to hear. Yeah.
But like most of us are super ADD. We're always trying to work on the little things. We're working on the things that probably just don't matter as much. Like, what is that one big lever that I can pull? And actually, Jonathan taught me this. Like he did a training for us called levers. Like what are those levers that you can pull that will dramatically change the business? Like if you're going to get a 5% return on this thing, or maybe it's a 5% decline, like for the first 30 days, is it really worth working on your time? Like I had this conversation with my stepbrother yesterday. I'm like, is that really something you should probably be focusing on right now in the business? Like your business is still pretty small. Like, is that really worth your time? Or is this everything over here, if you pull this lever, it's going to be 30, 40, 50% gains for your business? Like you really got to look at business as you grow a little bit differently, right? Like you said, where are you going to get the best return on your investment, which is your time and your own money. And you got to look at it as an investor, like Charlie was to his business, like you are to your business, not just an operator, right? You really have to look at it with a different lens, for sure.
Yep, that's a great point. Is that with JP, is that when the light bulb really went off for you on that concept?
God, there's so many light bulbs that guy gave me. So that's probably one of them. Like you've been around him a lot.
He always has the gems. Yeah.
Yeah. And yeah, just everything not everything, majority of what I've learned has came from that man, so credit to him and still to this day. But yeah, it's like that one training that we did 4 years ago, talk about levers. Like, oh yeah, it just makes total sense. And maybe it didn't make sense back then. Maybe it makes more sense 2 years later, but having those concepts in front of you can start thinking about,
Mm-hmm. Oh yeah. That's what's also important about, we talk about reading in books and continuous education, but actually like going back to books that you received a lot of value from, go back and read them again, because your business today, your life today is far different than it was, likely the first time you read that. And then there's like a whole new set of lessons and takeaways that you can get from that.
Yep. I agree. Cool, man. Well, you've already been here for an hour and a half, which is crazy because the time is flying by.
I know. We could go for another hour and a half too.
I know. This is awesome. And I'm really excited. Obviously, there's going to be a transaction happening. I wouldn't say in the near future, but in the future with us. And I'm glad to have people like you on the team and Paul on the team that can make those things happen. And definitely excited for the industry as a whole too. Like had some big deals, like you said, the Sala deals go through, which is just awesome because like, that's what you want to see. You want to see these big operators win. They're great at what they do. They're good people, and they go get a big number for that. It's just super cool to see, and it's very fun for all the young guys coming up saying, "Hey, we're going to be like that someday too." So,
and I'll even touch on that one for a second, just because those folks that operated that business, Sala, is that what I really take away from them that I think is a great learning for the entire industry is that when I've spent time with those folks, like I've never seen people treat other people better than Andrew, Blaine, and Daniel. And I think that in a people-based business like pest control, all of your team members and associates, your customers, your external suppliers, everybody you deal with, it's such a people-based business. So it should be no surprise to any of us that those guys and that team and the whole organization that they created were able to build such a big and successful organization. I just think it's it's something that, like, as an outsider, when I came into pest control, really struck me. And it's not only them, but it's other folks that have built big, successful businesses in these industries that are people-based, have similar attributes. Have you thought about that? Do you think that?
I mean, you were in the customer service business, right? So it all is people. It's all this. Our whole avatar is people. So, like, we're tech. It's just people. So it's not surprising. It just makes you, again, look at it from a different lens.
Yeah. I mean, and that was true too. One of the industries that I followed in my Wall Street career was retail, and the retail companies and businesses that did have a differentiated, strong culture, they ended up being the most successful. Because you have that culture permeating throughout the organization, dealing with customers at the front line, because you can't be there all the time, right? And when you have that unique culture, it definitely creates a bigger, faster growth, more durable organization.
Yeah, I've had a lot of people visit me in the past few years, and that's one thing, without me saying it to them, that's the one thing that they say when they walk in. They're like, I don't know what you've done here, but you have something's different as culture.
Yeah,
and I feel like
exactly.
I feel like I missed the boat on that culture thing so many years. Like, it was like a buzzword for so long, like culture.
Yeah, it sounds like BS, right?
Yeah, and then but now when I walk into like one specific office and something's off, I can feel the energy, and it's hard to even explain.
And I mean, you probably, I don't want to speak for you, but I mean, it seems like you've really transformed everything, right? Like your leadership across your organization, it seems like your team and everybody has just really followed your lead.
Yeah, but you have to lead from the front, Yeah, absolutely. And I can't make anything, any of my guys, girls, whatever, do anything that I haven't done or that I won't do myself. So it's like transform myself physically, emotionally, all the above, like to get better myself every single day too. And then that way I can go teach them, lead by example. I think I've said a million times on the podcast, like when I stopped drinking, what I didn't realize was going to happen is like the people around me stopped drinking. I never smoked. I didn't really drink that much as it was. So getting healthier at the gym, all of a sudden, like my team's going to the gym every day. I'm like, huh. And like the whole thing transformed. So, and then I feel like the more leaders that I brought in, like as the team got better and bigger, the kind of like the C and D players just kind of fell off naturally because our A and B players didn't want to work with them. And it's super cliche as it sounds, like A players don't want to work with B players. They typically don't. So it's just the whole team up level,
What I like to say is that like cliches become cliches because they're actually true.
For real.
Right.
But you come up and you hear this stuff all the time. And you're like, oh, whatever. And then you like live it. You're like, oh, yeah. Real thing.
Yeah. That's cool.
Cool. Well, man, again, I appreciate your time.
Yeah, we'll be in touch, and I'm going to be looking forward to watching you continue to do really big things. So
yeah, you as well. We got some plans together this year that we'll see each other at. So it'll be fun. But yeah, it's good chatting with you. Appreciate your time.
Of course, man. Anytime. Okay.
Hey guys, thanks for listening to another episode of Pest Control Millionaire. We don't charge any money for the show, obviously, but the podcast isn't free. You can pay for the podcast by sharing it with your friends and your family. So please like and subscribe and give us a 5-star review on your favorite podcast app. These things make a huge difference for us. If you have any specific questions you want answered about the business or your life by me or my guests, send an email to info@pestcontrolmillionaire.com. And if you want to get in touch with me about any personal business coaching, check out our website at www.pestcontrolmillionaire.com. Thanks again for listening, and I'll see you guys again on the next one.